So this shows the extreme danger of just following the trend, for example, and I will going to show you later, this was what the policymaker was doing. You say, oh, it's very good here, but they are not able to actually take into account the fact that this is a very non-linear dynamics, and if you extrapolate, you completely miss what can happen, a crash, a change of regime, or here a phase transition. What you show here is a physical example of a test tube which contains water. Water is easing progressively until ebullition occurs. And of course, what you see, the progressive dilation as you hit fluid, normal fluid around this, if you hit it, it dilates a little bit. So you say, aha, I'm going to predict what is going to happen when I reach 100 C, but you completely miss the fantastic phenomenon, which is the phase transition, the change of regime, which is associated in this case to the collective phenomenon between water molecules that give rise to a completely different regime. So let me give you another example additional to this little calculation on the blackboard as a toy process for understanding positive feedback and growth of rates itself, like R proportional to P. So suppose you have a population investment initially of 1,000 and the growth rate is 1%. Okay, here. Now, you know that for growth rate of 1%, the doubling time, so the time you need to wait in order to double your investment, is 69 years. Log 2. 1 over log 2. So it's quite a long time, not very good. But suppose in the model that when the population has doubled to 2,000, the rate of return doubles, 2%. So then the waiting time to double is of course half, to roughly 34.5 years. And then suppose in the model, in the process, each time the population doubles, the interest rate doubles. And so on and so forth. So what are you going to obtain? You obtain an increasing infinite number of doubling over a time which is 69 years at the beginning to for the first doubling, 69 over 2 for the second doubling, and so on. So this gives 69 times the series, 1 plus 1 half plus 1 fourth plus 1 eighth, which of course converge to 2. So this is called the Zeno paradox. You know, the Greek mathematicians and philosophers were troubled with their Zeno, who said an arrow can never reach a target because you still have 1/2 of the remaining distance to make. And then even if you have done the first half, you still have the next 1/2, the next 1/2, and they were troubled. They didn't have the mathematics to deal with the fact that you have an infinite series and how to give it sense. Now we know, of course, how to do it. And you have an infinite number of doubling in finite time. So to represent this as the return grows itself, you have this behavior which is very different from an exponential, which is slow initially, very fast, and then stop. The solution stop existing after 1. So that's a simple example to understand this finite time singularity. Does it exist? Okay, so this was theory, in a way. I don't show you the sophisticated, we have a lot of stochastic finite time singularity models on very different classes. They are very interesting mathematically, but I think it's much more interesting to discuss about the concept and also to convince you by looking at the data. So does it exist in the data, everything I said? So I showed you a lot of evidence that positive feedback are present universally everywhere, all the time. Now, do we see the consequences in the price? Let me start with a quite fashionable asset, which is Bitcoin. Maybe some of you. Has anyone traded or possessed Bitcoin here? No? Okay, so Bitcoin, you know, 2 or 3 years ago was valued a few cents of a dollar. Now 1 Bitcoin is $1,000+. The total calculated, you know what is Bitcoin, by the way? Yeah, it's an electronic currency which is supposed to replace the fiat money by central banks, and has become very popular, especially after quantitative easing, and especially after the problem of Cyprus in Europe, when suddenly it was realized the government could actually steal really 100,000 all deposit that you're in a bank and not actually redeem it. So you see a trajectory here where the price goes to more than $1,000 per coin, and in blue, so the dots are the Bitcoin value in dollar. The blue is the attempt to represent an exponential growth at a constant growth rate of 7% annualized. 700%. Huh? So it's completely wrong at the beginning, and it's also wrong at the end. Right? It's never a constant growth rate. This is the simplest one-dimensional fit with the hyperbolic formula of this type. It's much better, but not perfect. Of course, the reality is much more complicated. But here, what you see on the right is the annualized growth rate. So the instantaneous slope of appreciation, right? This quantity R that I was writing here. What you see is that it actually goes up, down, and so on, but during the bubble that corresponds to this unstable behavior, the growth rate grows itself. I remind you, a constant growth rate is the norm in finance, the norm in economics, is the norm in demographics. Everything is supposed to have a constant growth rate, and this gives rise to an exponential growth of the population, of your capital, and so on. Here we are describing processes in which the growth rate grows itself. The rate of return increases. And you see a dramatic illustration of the growth rate growing itself, giving rise to exactly this process, which is absolutely unsustainable. We were actually following in real time this in our group, and it was very clear that it will be bursting, and we were able to actually bracket quite nicely the time of this burst. And there has been other examples. By the way, for those of you who have some link with natural sciences, physics, and others, this process of positive feedback and finite time singularities are all over the place. So these monsters where the mathematical solution blows up in finite time are found for the, for example, dynamics of black hole, described by general relativity, the formation of planets in the solar system. It's believed to be a finite time singularity. The main point, by the way, is that in nature, in finance and economics, nothing diverges. The main point is that the dynamics can follow for a while, it is not sustainable, and something is going to happen to change, to impact the system. So we never go to the infinity, obviously. So the dynamics is only described for a while by these positive feedback processes, and that's very clear when you look at these different examples. So turbulence, earthquake dynamics, instability jets, and so on. The free droplets snap off I just described. And even, when you drop a coin on the floor, it happens, right, to all of us. You have a finite time singularity. Did you know that? It's called the Euler coin problem. You have the number of hits of the coin which is rotating, which goes like this, which goes to infinity in finite time, except that the infinity never is reached due to other processes like lubrication and plasticity. But you can actually have this all over the place. So it's a very general phenomenon. So when you realize the existence of the collective phenomena, like this clapping or this channel regime resulting from the interaction with positive feedback dynamics, you have, and this is very recent science that has been developing in the last 5-6 years, a number of precursor signals before this crisis occurs, before this critical time is reached. And I have made the list of those I know, I think the community knows. So, and the one that we have in our book that I'm going to present, the one which is mostly based on the singular behavior of the dynamics that announce its demise, its change. To continue examples, you all have heard about the famous tulip mania in Holland, right, in the Netherlands, in the 17th century, and the burst. So, this is a logarithmic scale, this is a linear scale. Log linear qualifies an exponential growth as a straight line, yes? Very clear. Where the slope is the rate of return. Do you see a straight line? You see a rate of return, which is a local tangent, it grows itself. Positive feedback, super exponential growth, the rate of return grows, and there is this process of acceleration. Same thing for the other historical case, very famous, the South Sea Company, where again, log scale, linear, straight line will qualify constant rate of return. No, the rate of return is slow, starts to accelerate, and diverge essentially. To extraordinary, not exactly diverge, but essentially tells you that it is not sustainable, and you can actually narrow down when the transition should occur. Other examples, now more controlled. This is a much more recent result that we have developed with Professor Hobbs from the Netherlands, by the way, where we used his experiments. You know, you can reproduce an artificial market in the laboratory, so like a room like this, we have students playing the game of investing with, of course, incentives and games. And what you see, and I don't go into the details because it can be reproduced, and this was, by the way, one of the most shocking and surprising results in the beginning of experimental economics that Vernon Smith developed. Now, Vernon Smith got the Nobel Prize, I think, in 2003 for being the pioneer of experimental economics. So putting economics in the lab, so in the lab meaning with people, real people, playing together, making games, or reproducing stock markets and so on. And what they discovered back in the 70s already is that even if you constrain a lot of information, you know that the price of the bond goes to zero and so on, nevertheless, the traders make the price go up in a hours. This was an incredible shock for the economists at the time. But there's been no revisit, essentially, of this, except for a few groups, because they found this, it's shocking, it is all over the place in finance, it's all over the place in experiments, control experiments. And this is what is shown here, where you see the price accelerating, intermittently crashing, and so on. And I want also to show you that when this phase is there, the rate of return over one period as a function of the previous period is first stable, should be there according to standard economics where it is the same or approximately constant, but you see diverge. As the return of time t plus 1 is larger than t, and t plus 2 is larger than t plus 1, etc., etc. In a very controlled setup, it was very interesting to see this. Another example, I mean, whenever you see now, you're going to look at the financial market, you're everywhere, of course. Huh? So, for example, this is the Hong Kong Hang Seng Index. I like it because it is indeed, it was actually, but still by now, the freest market in the world. No capital restriction, so it's like the textbook representation of a free market with no regulation. Essentially, the people are free to use their money as they want. So it's really the ideal free market situation in an experimental sense. And what you see, log scale, linear scale, straight line qualifies exponential growth with rate of 14%. Yes? Long term, yes. But short term, super exponential growth, crash. Super exponential growth, crash. The rate of return is accelerate, crash, and so on. The 8 arrows correspond to a peak followed by a crash, defined as I think 15% drop in less than 3 weeks. And you see the same pattern in all the cases. So the Chinese are really a dynamical guy. They essentially go through these phases of pushing the market in a non-sustainable way and then corrects, and so on and so forth. So now we can revisit the question we asked at the beginning. Why did the real estate market in the US stop growing, which led to the cascade of all the problems that we have seen since 2008? Guess what? The growth rate was growing. Yes? So it was absolutely sustainable. You could actually define the TC. So this is showing the same data, but going back further. So I was showing it in the previous slides, just from 2000, but now, up now. So I'm showing from 74. So the data I was showing before was something like this. So you see the strong acceleration. Now, this in black, this is the price, the real estate Case-Shiller index. In blue, you see the derivative, the log derivative, which means the local rate of return. It is not constant, should be constant, roughly on average. It's not constant, it's a phase where it is accelerated, it is growing, shown by this straight line. And by the way, in the past, if we go back to the 70s, 2 other peaks have occurred, which all of them, both of them, were characterized with a maximum also of the rate of return, which has gone through acceleration phase, characterizing, of course, an unsustainable behavior, which has to stop at some critical time, which is embedded in the dynamics and the process of underlying positive feedback. So it was very clear that it could not go on at all and was bound to break. So much so that actually in 2005, we did this analysis and published on the International Archive in June 2005 a prediction that by mid-2006, indeed, we should reach the TC and the Shannon regime would occur. So it was completely clear that this was the unsustainable dynamics. Now, so how much more do I have? Because I have no concept of time now.
40 minutes.
40 more minutes. Okay.
35.
Okay. You're not tired? No? Okay. So, this builds possibility to develop a methodology for systematic diagnosing bubble. I'm going to show you a little bit how it works, but essentially showing you results about the state of the world. So we use, now you have understood, you must be fed up with my repetition, we use positive feedback, where you have higher return anticipation, it gives rise to super exponential price, the rate of return is not constant, that's an exponential dynamics, it's accelerating itself, super exponential, and this gives rise to the mathematics of finite time singularity, which we tend to ignore in economics because we impose existence, as you understand now. And we complement this by something that I've put aside, and I will just say rapidly in words, by realizing the following. I mean, if you have followed me until now, I've painted a very simple picture, too simple, of course, which looks at the bubble as just this monotonous behavior. Okay, there is noise, there is volatility on top of it, of course, but it's not actually just the only story. Of course, during the development of the bubble, expert investors know that there is something aloof, that there is something developing that may not be justified by the fundamentals. So there's a lot of talks about bubbles and so on. I remember I often, even early on, I often spoke with internationally in Hong Kong, in Japan, in Singapore, in the US, about this type of analysis. And the chief investors, many of them told me, Didier, we don't need your stuff, we knew it was about. So then, I mean, if you do your homework, you are a savvy investor, portfolio manager, you know that there's something fishy, that it's not, the price cannot really be sustainable for a long time. The big problem they all have is that they know roughly that there is a bubble. They have no idea when it will stop. And this is very clear. There are very many tellings or proverbs, but basically they condense to the situation of saying, well, nobody is rich enough to surf a bubble, to short a bubble when you detect one. And a good example of this is by Greenspan. You know, Greenspan was the chairman of the Federal Reserve until 2000, something like 2006. He famously issued the term in a committee to Congress of irrational exuberance. Maybe it's a term that you have read, it's the title of a book by Bob Schiller, Irrational Exuberance. So it was in late 1996, and he was referring to the dynamics of the US market, that there was irrational exuberance, 1996. So he was saying, yeah, we have to do something to calm down. When did the crash occur? April 2000. So if you follow Greenspan, you follow the central bank, you say, aha, there's something fishy, the market is overheating, irrational exuberance, you start to short. I mean, you should short, right, as an economist, a rational economist, you start to short at the end of 1996. You lose everything because you have to short continuously and roll over your dynamics for 4 years, 3 years. No, so, okay, so that's the big problem. So people know about the bubbles in general, and as they know, they think that the crash may occur maybe here, or maybe here, or maybe here. So what is happening is that you have local corrections which are perceived as the diagnostic that, aha, the crash is going to be here. But it does not. And what is happening is that people, when they see the price at this level, say, oh, it is cheap. Now, it is, of course, it's not cheap if you take the reference here, because it's still a big difference. But it's cheap with respect to what humans always take as a reference, which is the past level. This is one of the famous behavioral traits that we have. It's called anchoring, which makes us make a lot of mistakes, by the way. So we anchor on this value and we say, oh, this is very cheap, so let's buy massively. And so the bubbles goes on, and it can go through these different waves of what I call long wavelengths or long-term volatility that are punctuated and otherwise optimistic behavior. So you have this intermittent phase of panic, or close to panic, or strong fear, where the put options become very pricey, which are punctuating this ascendance of the price. So we combine this intuition by putting this in mathematical language, and we take into account this accelerating large-scale financial volatility, and this gives rise to specific structure, which can be called long-periodic discrete scale invariant structure, decorating this finite time singularity dynamics. And this is how it looks in the simplified form, where the log price can be written. I've removed all the stochastic component as a component which expresses this super exponential acceleration, and a component that takes into account these spells of panic intermixed in the overall bubble dynamics. You see the Tc minus T that we derive together, and this is an oscillatory component which is very special because it's in the log also of the Tc minus T, so it contains also the information about Tc. And we have found this extremely valuable in order to make the prediction. For example, let me show you now how it works concretely when we implement it. This is an example in 2011. This is silver. Silver as a function of time for the period around 2011 when the crisis was in full-fledged, full development. And you see the price here as a function of time, which exhibit this acceleration behavior, but also decorated with transient period of panics and so on. You see the multiple curves here correspond to multiple calibration of the theory. And you see here in green, the mountain, green mountain, is our indicator that you have built in order to characterize the most probable time for the TC, for the channel regime. And this, I can tell you, this case, in all my life, I've been working in this subject for now 18 years, this is the best case I've ever seen. We were able to follow in real time to the minute the TC. We could predict at the precision. I never seen that. Usually for big crash, we have a precision of a month, 2 months. Here it was at a minute. It was like a perfect incarnation of this type of equations. So you see, again, positive feedback, non-sustainable regime, it has to crash. Another example, which I like, of course, because I live in Switzerland, is the Swiss franc against euro. But I think also the Russian should like it, because many buy Swiss franc also. Swiss franc during the has been and is still a defensive currency. Clearly, I mean, if you think as an investor where you would like to put your money, I mean, in this very uncertain world, what is the currency which is really used trust? Before the Swiss franc was pegged to the euro, I mean, Swiss franc, obviously for many, many reasons. So during the development of the Greek problem, you may remember the Greek were bonds in particular were collapsing with the yield skyrocketing and so on. We saw this trajectory of the Swiss franc in Europe. So just a few months before the peak here, you had 1 Swiss franc maybe equal to 0.8 euro. And then you start to live like this process and so on. And at the peak here, which was in August 2011, we reached essentially parity. 1 euro, 1 Swiss franc equals 1 euro. Actually, 3 years or 4 years before, I remember because I was spending in euro and earning a salary in Swiss franc because I had some expenses in France. 1 euro was 1.7 Swiss franc. And it reached parity just a few years later. Incredible. 1 to 1. Actually, exactly 1 euro equals 1.0079. That was the maximum of Swiss franc one day. Now, the Central Bank of Switzerland intervened, and this is, you see, the floor of €1 equals 1.2 Swiss franc. You may know that this is something that the central bank has imposed. And indeed, you see, after a while, the price had remained below, so because we were looking at Swiss franc in euro here. But what the central bank doesn't explain is that the floor, or the ceiling, if you like, in this version, the ceiling only started on 7th of September 2011. So their action of publishing and imposing this did not actually cause the crash. So the crash of Swiss franc in Europe. Yeah? So what caused the crash? So our interpretation is the following. We were following this also in real time. This was going through these characteristic positive feedback, super exponential non-sustained behavior, blah, blah, blah. You could pinpoint quite well, within a few days actually in this case, the time where the process was going to rupture. So what does it mean? It means that something is going to happen, that some investors, regulators, politicians, something is going to happen. And we don't know, of course, what happened, but the correction occurred, it was not sustainable. And it's very interesting because I had a discussion recently with one of the head of the Swiss National Bank. He was giving a big presentation about their policies and how it was going to impact the future of Switzerland and so on. And I asked him what happened from this time to this time. Did they do something? Of course they did something, he didn't want to tell me. But he actually revealed that they did not understand what happened here. And they did not understand because they are using these standard economic models, which are linear, which doesn't take into account positive feedback, and doesn't take into account this finite time singularity and this rupture. So it's very interesting to contrast the standard view of the action and so on with the one in which you understand the non-sustainability of behavior. And I will show you another example which is extremely instructive, which is the present case of the Turkish lira, and with a recent episode just the last few days, in a few minutes. So these are just a few examples. I'm going to show you many more, but we can paint now a big picture for understanding the crisis. I told you, and this is the first message, that if the real estate in the US had not stopped growing and have continued to go for forever, then we would not have gone through the financial crisis. Then I told you, yeah, but when we look at the super exponential behavior, non-sustainable behavior of the real estate market growth, this was bound to happen. Okay, but now, next level of thinking. Where did it come from? Can we go deeper in the roots of the crisis, informed by the mechanism that I presented to you, in terms of all the elements of positive feedback? And the conclusion is yes, we can actually go back, and this is simply a summary of understanding the root cause of the crisis that emerged in 2007-2008 as embedded in essentially 30 years of what we call the perpetual money machine. So this is the list of 7 massive, most important bubbles that have punctuated the dynamics of markets, starting with the 1980s, which ended in a crash, which was a worldwide crash. I think only Russia, Soviet Union at the time, Cuba, and China didn't crash, for obvious reasons, because we were decoupled at the time from the international markets mostly. But the rest of the world, everywhere, from Israel, New Zealand, Australia, Canada, US, Europe, and so on, Japan, South America, everybody crashed. And this was the first actually spell of a transitional regime that I'm going to mention a bit more already later on. And you had several spells in between, but the next big bubble was the new economic bubble that I already alluded to. You had the real estate bubbles in the US, but in also in quite a few other countries. And you had these bubbles in financial innovation, like mortgage-backed security, collateralized debt obligation, and so on. So the inflation, the growth of the financial sphere. You had a stock market bubble in several countries, in particular the US. And you have many bubbles in commodities, oil, and so on. And of course, the debt bubble. Let me show you.